Everyone knows TSMC. Everyone knows Nvidia. But almost nobody talks about UMC. Why? Today, investors are obsessed with artificial intelligence. Everyone is chasing the same companies. Nvidia, TSMC, AMD, Broadcom. The biggest names dominate every headline. But what if one of the industry's most essential foundries is being overlooked? A company that has been manufacturing chips for more than 4 decades. Serving hundreds of customers around the world. Generating billions of dollars in annual revenue. And quietly supplying the mature node chips that power countless everyday technologies. That company is UMC. And here's the surprising part. UMC isn't trying to become the next Nvidia. And it was never trying to become TSMC. Because UMC chose a completely different battlefield. While much of the market is focused on advanced AI chips, UMC specializes in mature process technologies that power cars, industrial equipment, networking devices, and many products we rely on every day. The world still needs billions of these chips every year. And that demand isn't going away anytime soon. So the question is, has the market been overlooking an essential piece of the global semiconductor industry? Or is UMC simply a forgotten stock with limited potential? Today, we're going to find out. At first glance, many investors assume UMC is simply a smaller version of TSMC. But that's actually the wrong way to think about this company. Because UMC was never trying to become TSMC. And understanding that difference is the key to understanding its entire business. Unlike Nvidia, AMD, or Qualcomm, UMC doesn't design chips. Instead, it manufactures chips designed by its customers. This business model is known as a semiconductor foundry. Think of it as a highly specialized factory. Customers provide the blueprints. UMC provides the manufacturing expertise, facilities, and production capacity needed to turn those designs into physical chips. Today, the company serves hundreds of customers across multiple industries. Its chips help power automobiles, industrial equipment, networking devices, display systems, and countless products we use every day. And here's where many investors make a mistake. They assume every semiconductor company is trying to build the most advanced AI chips. But not every chip needs to be cutting edge. In fact, much of the modern economy still depends on mature process technologies. Technologies that prioritize reliability, cost efficiency, and long product life cycles over raw performance. And that's exactly where UMC operates. It deliberately chose a different market. Not the race to build the smallest transistors. But the business of supplying the billions of mature node chips that industries around the world still depend on every single day. Because while advanced AI chips capture headlines, the rest of the world still needs chips to function. And that may be the most overlooked part of the entire semiconductor industry. When people think about semiconductors today, they immediately think about artificial intelligence. And for good reason. AI is transforming the industry. But here's something many investors often overlook. AI is only one part of a much larger semiconductor ecosystem. Not every device needs the world's most advanced chips. In fact, many products we rely on every day prioritize something else entirely. Reliability, longevity, and cost efficiency. Think about automobiles, industrial equipment, Wi-Fi routers, display systems, power management devices. These products are often designed to remain in service for many years. For their manufacturers, stability matters far more than having the latest process technology. Using cutting-edge chips can be unnecessary and, in many cases, economically inefficient. That's why mature process technologies continue to play a vital role in the global economy. And this is exactly where UMC has built its business. Instead of competing to manufacture the smallest transistors, UMC focuses on producing mature node chips at massive scale. That decision may not generate headlines, but it creates something investors should pay attention to. Persistent demand. Because even in an AI-driven future, factories will still need chips. Cars will still need chips. Communication networks will still need chips. And billions of everyday devices will continue to depend on these technologies. The world doesn't run on AI chips alone. It runs on an enormous ecosystem of semiconductors working quietly in the background. And UMC has positioned itself as one of the companies helping to supply that ecosystem. Perhaps that's why this company is so easy to overlook. Its products are rarely visible to consumers. But its role remains deeply embedded across multiple industries. And for long-term investors, businesses that quietly become indispensable can sometimes be more valuable than businesses that simply capture headlines. At this point, many investors may be asking the same question. If UMC is so important, why doesn't it receive the same attention as TSMC? The answer is surprisingly simple. Because they're playing different games. Many people automatically compare UMC to TSMC. But that comparison can be misleading. UMC was never trying to become another TSMC. And understanding that distinction is essential. TSMC has built its business around leading-edge technologies. Its customers demand the most advanced chips available. That means constantly pushing the limits of engineering. Smaller transistors, higher performance, and enormous capital investments. UMC took a different path. Instead of competing at the technological frontier, it focused on mature process technologies. A segment where customers often prioritize reliability, long product life cycles, and cost efficiency over absolute performance. This strategy may sound less exciting. But it also comes with different economics. UMC doesn't need to win the race to build the world's smallest chip. It needs to manufacture dependable chips at scale for industries that value stability. And that distinction matters. Because not every semiconductor company has to be a technological pioneer to create value. Sometimes, specialization can be an advantage. By avoiding the most expensive battles in the industry, UMC reduces some of the risks associated with constantly chasing the next breakthrough. Of course, this also means the company may never experience the explosive growth that investors associate with leading-edge AI businesses. But that was never the objective. UMC isn't trying to dominate headlines. It's trying to remain relevant to industries that still depend on mature node technologies every single day. Perhaps that's why investors often underestimate the company. They measure UMC using the wrong benchmark. Instead of asking why UMC isn't TSMC, maybe we should ask a different question. What happens if the world continues to need mature node chips for decades to come? Because if that demand persists, UMC may not need to win the technology race at all. It may simply need to keep doing what it has already been doing for more than 40 years. Many investors assume semiconductor manufacturing is a simple business. A customer designs a chip. A factory manufactures it. And if a better supplier appears, customers can simply switch. But that's not how this industry works. Once a chip has been designed, tested, and integrated into a product, changing manufacturers can become extremely difficult. Because every foundry has its own production processes, engineering requirements, and manufacturing specifications. Even small changes may force customers to redesign parts of their chips and repeat extensive validation procedures. That process can take months. And in some industries, even years. The challenge becomes even greater in automotive and industrial applications. These customers often build products that remain in service for a decade or longer. For them, reliability is far more important than constantly searching for a new supplier. Once a manufacturing partner has proven its consistency, customers are usually reluctant to make changes unless absolutely necessary. And that's where UMC has built one of its advantages. Not because customers are permanently locked in, but because switching suppliers introduces costs, delays, and operational risks that many companies would rather avoid. Of course, this doesn't make UMC immune to economic cycles. Demand can still rise and fall. But long-term customer relationships can create a level of stability that investors often underestimate. And perhaps that's one reason this business is so easy to overlook. UMC isn't selling a product that consumers recognize. It's building trust inside global supply chains. Because in semiconductors, trust isn't established overnight. It can take years to earn. But once it's earned, replacing it becomes much harder than many people realize. And that raises another question. If UMC has an established position, long-term customer relationships, and a business model tied to essential industries, why does the market still overlook this company? At this point, a different question starts to emerge. If UMC plays an essential role in the semiconductor industry, why isn't it discussed more often? Part of the answer comes down to attention. Financial markets are naturally attracted to companies with bold narratives. Businesses that launch breakthrough products, disrupt entire industries, or generate explosive growth. UMC is not that kind of company. Its products are invisible to consumers. Its customers are other businesses. And much of its work happens quietly in the background. That makes UMC easy to overlook. There's another reason as well. Many investors associate mature technologies with stagnation. They assume that if a company isn't operating at the cutting edge, its future must be limited. But those are two very different ideas. A business doesn't have to lead every technological breakthrough to remain valuable. Sometimes, its value comes from serving markets that continue to exist year after year. And that's exactly where UMC operates. Its customers often prioritize reliability, long product life cycles, and supply chain stability over constantly adopting the newest technology. That may not sound exciting. But excitement and durability are not the same thing. Some businesses attract attention. Others become deeply embedded in the global economy. And businesses that become deeply embedded can remain relevant for a very long time. Perhaps that's where the market occasionally creates opportunities. Not because it is completely wrong, but because attention tends to concentrate in a few highly visible areas while other essential businesses receive far less scrutiny. Of course, none of this automatically makes UMC a great investment. A company still has to prove that its business translates into financial strength. Because an essential role in the economy means very little if it doesn't produce sustainable profits, healthy cash flows, and shareholder returns. And that's exactly what we need to examine next. Up to this point, we've talked about UMC's role in the semiconductor industry. But none of that matters if the business cannot translate its position into financial strength. Because an essential company is not automatically a great investment. Its business model has to produce sustainable profits and healthy cash flows. And this is where UMC becomes interesting. UMC is not a hypergrowth company. Its revenue rises and falls with semiconductor cycles, which is normal for the industry. But over time, the company has shown an ability to remain profitable and generate meaningful cash flow. And that tells us something important about its strategy. UMC deliberately chose not to compete in the most expensive race in the industry. It isn't spending enormous sums every year trying to manufacture the world's most advanced chips. Instead, it focuses on mature technologies that many industries continue to depend on. That decision creates a different financial profile. The company still requires significant investments, but it avoids some of the extreme capital pressures associated with leading-edge manufacturing. As a result, operational discipline becomes just as important as technological innovation. And for long-term investors, that distinction matters. Because not every successful business needs to grow at extraordinary speeds. Some businesses create value by remaining profitable, generating cash, and staying relevant through multiple industry cycles. That doesn't mean UMC is immune to volatility. Far from it. The semiconductor industry will always experience periods of strong demand and weaker demand. But perhaps that's not the right way to judge this company. The more important question is whether UMC can continue doing what it has already been doing for decades. Supplying essential industries while maintaining a financially disciplined business. Because if it can, that may explain why this company has managed to remain relevant for more than 40 years. However, there is one issue that investors cannot afford to ignore. And it has nothing to do with technology. It has everything to do with geography. There is one topic that every UMC investor eventually has to confront. Geopolitics. Like many Taiwanese semiconductor companies, a significant portion of UMC's operations is concentrated in Taiwan. And that exposes the company to tensions between China and Taiwan. This is not a temporary concern. It's a structural risk that investors must recognize. Because any major disruption would extend far beyond a single company. It could affect global supply chains that support automobiles, industrial equipment, communication networks, and countless products used every day. In many ways, this uncertainty helps explain why some Taiwanese semiconductor companies trade at lower valuations than investors might expect. The market demands compensation for taking on additional risk. And that valuation discount may persist for a very long time. Of course, no one can reliably predict geopolitical outcomes. Trying to build an investment thesis around political forecasts is rarely a good idea. Instead, investors should focus on something more practical. Acknowledge the risk. Incorporate it into expectations. And decide whether the potential return justifies the uncertainty. Because geopolitical risk should never be ignored. But it also shouldn't become the only lens through which we evaluate the company. After all, UMC has operated under this environment for many years while continuing to serve customers around the world. That doesn't make the risk disappear. It simply reminds us that investing is rarely about certainty. It's about understanding trade-offs. And perhaps that's what makes UMC such an interesting case study. The business itself may be relatively straightforward. The difficult part is determining how much geopolitical uncertainty is already reflected in the stock price. Because if the market is already pricing in a meaningful amount of risk, then the next question becomes extremely important. Is UMC actually undervalued? At this point, the most important question is no longer about today's stock price. It's about the next decade. What could keep UMC relevant for years to come? The answer may be simpler than many people expect. The world is becoming more dependent on semiconductors. Not just advanced AI chips, but a wide range of specialized chips that perform specific functions. Take the automotive industry. Modern vehicles contain significantly more semiconductor content than they did in the past. The same trend can be seen in industrial automation, networking infrastructure, and connected devices. As products become more sophisticated, they require more electronics to operate efficiently. And many of these applications do not necessarily need leading-edge technology. Instead, they often prioritize reliability, long product life cycles, and stable supply chains. These are exactly the areas where UMC has built its expertise. Of course, none of this guarantees future growth. Technology evolves. Competition changes. And demand will continue to move through cycles. But UMC does not need every new trend to become a major success story. Its business is connected to multiple industries that continue to require mature node semiconductors. And that diversification may be one of its biggest strengths. Perhaps that's why UMC has remained relevant for more than 40 years. Not because it constantly reinvents itself, but because it continues to serve industries that the global economy still depends on. And maybe that's the most overlooked lesson here. The future of semiconductors isn't only about building the fastest chips. It's also about supplying the countless chips that quietly enable modern life. Because even if the next decade belongs to AI, the world will still need factories. It will still need communication networks. It will still need vehicles. And it will still need billions of mature node semiconductors. The question is whether companies like UMC can continue supplying that demand. And after more than 4 decades in this industry, perhaps that's exactly what UMC is trying to do. After everything we've discussed, one final analytical question remains. How should investors think about UMC's valuation? Perhaps the first thing to understand is that valuation is ultimately a reflection of expectations. The market is constantly weighing a company's strengths against its future risks. And in UMC's case, both sides of that equation are meaningful. On one side, UMC has several characteristics that investors may appreciate. It has decades of manufacturing experience, long-standing customer relationships, and exposure to industries that continue to rely on mature node technologies. On the other side, investors must also account for slower growth expectations, cyclical demand, and geopolitical uncertainty. That's why UMC cannot be evaluated in the same way as many leading-edge semiconductor companies. Its investment case is different. This is not a business built around explosive growth. It's a business built around durability. And businesses built around durability often require a different framework for valuation. Perhaps that's the most important distinction. A low valuation multiple does not automatically make a stock attractive. And a stock trading near its highs does not automatically make it expensive. What matters is whether future expectations are realistic. Because over long periods of time, stock prices tend to follow business performance more than narratives. And that may be especially true for a company like UMC. The better question isn't whether UMC is cheap or expensive. The better question is whether today's price appropriately balances its opportunities and its risks. Reasonable investors may arrive at different answers. And that's perfectly normal. Because valuation is rarely about certainty. It's about probabilities. And perhaps that's the most disciplined way to approach UMC. Not by asking whether it's a stock to buy immediately. but by asking whether its current price offers a balance between durability and uncertainty that fits your own investment framework. Because in the end, that's what this entire analysis has been about. Understanding a business before making a decision. And that brings us to the final takeaway. How should investors ultimately think about UMC? Valuation should not be viewed as a prediction. It should be viewed as a framework. A way to understand what expectations are already reflected in the stock price. For UMC, our historical scenario suggests a fair value of around $8 per share. But ultimately, the investment outcome will depend on whether the business performs better, worse, or roughly in line with those expectations. After everything we've discussed, perhaps the most important takeaway is this. UMC is not a company that attracts attention in the same way as many of today's technology leaders. It isn't pushing the boundaries of leading-edge semiconductor manufacturing. And it isn't at the center of every AI headline. But that doesn't mean it lacks importance. In many ways, UMC represents a different type of investment story. One built on durability rather than excitement. The company operates in a segment of the semiconductor industry that often receives less attention, yet continues to play an important role in modern technology. From industrial systems and communication infrastructure to automotive applications and countless everyday devices, mature-node semiconductors remain deeply embedded throughout the global economy. That doesn't make UMC a perfect business. The industry remains cyclical. Competition remains intense. And geopolitical risks cannot be ignored. These challenges are real, and investors should approach them with clear eyes. At the same time, UMC has demonstrated an ability to remain relevant through multiple technology cycles and changing market environments. Not by chasing every new trend, but by focusing on what it does best. Perhaps that's why the company continues to occupy an important position within the semiconductor ecosystem. And perhaps that's also why investors continue to revisit the stock whenever market conditions begin to improve. Ultimately, whether UMC is attractive at today's price is something each investor must decide for themselves. But regardless of where the stock trades tomorrow or next year, understanding the business behind the ticker is what matters most. Because successful investing is rarely about finding the most exciting company. More often, it's about understanding the economics, risks, and long-term prospects of the businesses we own. And in that respect, UMC remains a company worth studying. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching, and if you enjoyed this analysis, don't forget to like, subscribe, and share your thoughts in the comments below.